Well, good afternoon. We're a little bit late starting. We had a few technical issues, but we're back on, and we're glad you're here. Glad you joined us today. We're live from the bank's downtown offices here in Amarillo, and this is our third presentation in our Live with the Experts series. Unfortunately, we couldn't find any experts today, so the three of us are standing in. We'll try to do the best we can. Today we're going to be talking about small business lending. And I'd like to start out just to introduce ourselves before we get into it. My name is Steve Bowen. I'm the Amarillo Market President. And I have 35 years of banking experience and 11 with this bank. And I know you're looking at me thinking, how can a guy that looks that young have 35 years of banking experience? I know Scott and Jeff are thinking that. But, right, guys? Anyway, that's the way it is. It started when I was 5. But so I'll let Scott and Jeff kind of introduce themselves. So.
Hello, everybody online. Scott Martin. I have been in banking for 17 years. I am currently a commercial lender and the bank president at the Saucy location. Glad to be on and happy to be talking to all you guys about small business lending.
I am Jeff Beamister, and I'm the young one in the group, obviously. I think that's why I was asked to be part of this panel. But I am 8 years with the bank at this point, all of my professional career, really. After a finance degree from WT, started with the bank and have been in some form of the lending function for the last 5 or 6 years. So.
Well, thanks, guys. As I said earlier, we want to talk a little bit about small business lending, and specifically, I think we'll want to make a few comments, and then we'll open it up to questions. But we want to address, what does the bank look for when we're evaluating a loan request from a small business? And I think the best way to answer that is to discuss what we call the 4 C's of credit. And these are 4 major areas that a lender will look at when we're evaluating the credit risk or the credit worthiness, I guess, of the company. To make it easier, we have all these 4 areas begin with the letter C. Bankers always want to make things as easy as possible. We need all the help we can get. So the first C, I'll talk about that. The first C is what we call character. And, this is not just how good of a guy you are. And it's not just the obvious things like, how well has the company paid how well do they pay their bills? How well do they make their loan payments? Things like that. Do they pay on time? And do they have a good reputation in the business community? So it's not just things like that. It's also things like, how long has the business been open? And then how much management expertise does the business have? How well do they do what their business is all about? How well do they know that technology or that service? Is the market that they're in, is that conducive to the business that they're in? And another thing we look at is there a concentration of customers? In other words, are they just selling to a few big customers, or do they have a diverse number of customers they can kind of spread that risk out over? And then what is the demand for their product or service in the market that they're in? And then last part of character is, do they have a good business plan and a good marketing plan, and do they stick to that? Do they know where they're going and how they're going to get there? So those are just some of the things that we look at under the C of character. What's the next one, Jeff? Tell us about the next C.
Yeah, Steve, cash flow is what I wanted to discuss today and wanted to share with you all. Cash flow is, I would say, one of the more critical pieces of any deal you're looking at. But cash flow also speaks to, folks personally. You can really look at it from a personal budgeting standpoint or a business budgeting standpoint. But cash flow at the very basic level comes down to 3 things. You're talking about income. If you're on a personal level, you're talking about what your income is, what your salary is. On a business side, you'd be looking at sales you're generating, what your revenue streams are, and how much just gross money you can pull in and put in your pocket. The next piece what I would say is considered to be like an operating expense. On a personal level, that would be what it takes you every month really to just to live. Normal expenses, utilities, food, groceries, things like that. On the business side, an operating expense is going to be similar. What are your utilities? What are some of your hard costs, your salaries, taxes, things of those natures? And then when you break that down, you've got your salary or your income on the business side minus those basic expenses, and then you get to what we call a net income figure, right? And net income, guys, is what we're going to look at to assess how well a business can cash flow, what their debts are. Debt being the final piece of that. Any structured debt, mortgage or real estate loan, auto debt, equipment debt, things where you have a structured term payment and a portion of that you're coming out of an expense every month. And then we want to make sure that income can cover all that debt service on a monthly basis. The goal being obviously to have cash in your pocket, cash flow. You want there to be cash flowing anytime you're looking at your personal budget or a business budget. You want to have money left over at the end of each cycle, whether that be a month, quarter, a year. The goal is to generate enough revenues so that you have money left over to either put in your pocket or continue to grow your business.
And that cushion between the cash outflow and cash inflow is very important too. We look at that as well.
Right, absolutely. Yeah. And cash flow really can also be historical if we're talking about tax returns, look at old income information. Or if this is a startup business, which is what we're touching on today, you might provide projections, projected sales, projected expenses, and then how are those projections going to be able to pay the debt that you're looking to incur?
Scott, tell us about the other C's.
Okay, I'll cover the third and fourth C's of credit, with the third being collateral. So collateral is something that probably most business people are more familiar with than some of the other C's we talk about. So collateral, what is collateral? Those are business assets that a business owner would pledge in order to secure a loan. So that can come in the form of, most often, cash, accounts receivable, inventory, equipment, and then in a lot of cases, real estate. So the bank most often requires collateral in order for it to extend credit to an individual borrower. But the bank is also looking to really form a partnership with the customer, and that partnership a lot of times comes in the form of what a borrower is willing to do in terms of helping fund the asset needs of a business along with bank funds. So we see it as a partnership. We like to call it skin in the game because our borrowers truly are matching some of our funds with their funds. So what happens in the case of somebody having good equity, a business having good equity in the assets, is oftentimes if they experience a little bit of a cash crunch, if you have equity in an asset, you're sometimes able to convert those to cash, which can help you get out of a time where maybe a business is struggling. So that kind of ties into the 4C, which is capacity. So the bank is always looking for a borrower or an individual behind a borrower, and what their capacity is to repay a debt should they experience any sort of cash flow interruption. So any good business or a good startup plan is going to have a blueprint for their ability to repay debt and accompany overhead should they experience an interruption. So what would be an interruption? So a business sells a product, they sell a service, they extend terms on that product or service. Well, sometimes there may be delays in the collection of that. That can create a shortage of cash. So another good example that a lot of business people are familiar with is you carry a level of inventory. Maybe some of your inventory you find out is not as marketable, it becomes stale. So in that case, how does a business create enough cash to pay its labor, to pay all of its overhead when they experience that sort of interruption in their cash flow? Well, that comes from capacity, and we like to refer that in another way as capital of a company. So capital can be equity that a borrower has infused into a business. It can also be a period of historical earnings where the borrower has really been able to match a lot of the assets that it has purchased within a company with their own funds without relying on bank debt.
Okay. Thanks, Scott. Well, that kind of sums up or gives us a brief overview of how a bank looks at a loan request. I'd like to open it up to questions. We'd like to hear your questions, things that you would like to hear us talk about. So let's open it up.
Okay, our first question is from Hunter. He says, I have an idea for starting a new business, but don't know how to start the process. What do I need to think about?
Well, that's a great question, Hunter, and we get asked that all the time. And I would say, the first thing you need to think about is putting together a business plan. And a business plan is going to include things like, your market niche. Number one, who am I going to sell my products or my services to? And then the demographics of that. This customer base I'm going to sell this product or service to, is this something that they want or they need? And is it affordable? The people I'm going to be selling to, can they afford my product and service? So that's one of the first things you start out in a business plan, talking about a business plan. Jeff, what are some other things in the business plan?
Yeah, just to tie back into what you guys have talked about already. How do I market my product? Who am I going to market my product to? And then secondly, to something Scott mentioned earlier, how much capital am I going to need to get into business, and how's that going to look as I plan it out and map this out? So in terms of marketing, you have to identify who you're going to market your product to ahead of time. I mean, that has to be a crucial part of your plan. You can't go into business assuming that people just want your services or want what it is that you're having to offer.
Build it and they will come.
Right, yeah. It can't all be speculative. I mean, every startup, in theory, is somewhat speculative. You're hoping that there is a market for your service, but at the same time, there are plenty of resources. There's plenty of information that you can get out there, and you can acquire some knowledge to help you form who it is that you're specifically going to be marketing to and how it is that you're going to market your product. And if you're going into sales, if you're going to be providing whether it's inventory or kind of a base product to someone else in their businesses, then you need to maybe go out and get in contract with those folks. Maybe get in agreement that these people are going to have contracts. They're going to be in desire and capable of purchasing and acquiring your products or services, and have some of that lined up beforehand. And then in terms of how much capital you need, Scott touched on it a little bit earlier, but that can vary depending on what kind of asset you're talking about. 20% to 30% is kind of a banking general rule of thumb in terms of how much cash you may need to put into something. To partner with a bank is a term Scott used earlier. If we're talking about real estate, that's a long-term asset that you might put a little less equity in on the front end, but when you start going into short-term assets, inventories and accounts receivable and different things like that, you should be prepared to have more of your money, more capital, whether it's yours, whether it's your partner's or your business. You should be prepared to have more money into those type of things.
Yeah, those are great points. You guys have both talked about conceptually what I'm going to do if I'm a businessman. What type of business do I want to go into? Obviously, up to this point, you've created a concept of what you want to go out and sell or market, whether that be a product or service. But at this point in your business plan, you're talking about just a concept. So let's talk about the financial aspects of that, because that's what drives a business. So the financial section of a business plan is going to be the most essential component of it. This is something whether you plan on financing with your own capital or having investors, or you, again, are looking for a partnership with the bank. So it's very important to do a lot of diligence when you're coming up with a financial forecast. Again, whether you're using your own money or you're using a portion of the bank's money, that way you can find out if you really have something that's viable and sustainable into the future. So the financial aspects of a business plan, there's really two components. So the first one is projections. So the best way to do this is to look at what you're going to do on a month-to-month basis. And again, they are projections, but using as many resources, as many industry partners as you can find and helping build those projections, you have to be able to come up with an idea because, let's face it, from day one, you may have a good idea what your cost is going to be to run that business, but you're not going to have any revenue. So it's really critical to look at a business in a 2 to 3 year time period and look at it on a month-to-month basis. So you're going to have to be able to use a lot of the data and knowledge you have to start building what you anticipate your revenue being from month 1 to month 2. And the expense side of it's a little bit easier. You may be going into it with a partner. You may have some administrative help. You also will have possibly rent payments, utility payments you'll have to make. There's various other operating expenses that are required in order to run that business effectively. So when you initially get into a business, it's very common that from day one you're not going to be at income, from an income standpoint, making money. So you have to, again, use a lot of the research you've done and determine where is my break-even point? Where do my revenues need to be in terms of being a break-even? So in those initial months, if not maybe the first year or two, you got to determine how much working capital, so this is cumulative effect of losses that you may have, and how is that going to be funded? So that would be funded by looking at your overall budget. So the overall budget, again, would go back to what is it going to cost me to operate this business until it reaches a break-even point? And then you need to be looking at things like equipment. Do I have to have equipment in order to operate this type of business? What are your initial startup expenses? A lot of times you'll have to partner with an attorney to get your legal entity set up. You'll have accountants. So there's a lot of variables starting a business, and all those need to be taken into consideration. And then when you form your overall budget that it costs, then you have a good idea when you go into your bank to talk to your banker about, here's what we anticipate needing to run this business. So, and again, that's where you're looking, going back to the partnership with, this is how much I can bring into the business. You figure out this business plan is very viable. The bankers are going to provide a lot of assistance to that. And I think there's a lot of other resources.
Yeah, we've probably sufficiently scared off anybody that's going to start a new business to have provided. But it's really not as difficult as all that. And there, like Scott said, there is a lot of help. There's the Small Business Development Center, which is actually in the basement of this building downtown. And they're funded by West Texas A&M University and the Small Business Administration. And there's also the Enterprise Center, which is also funded by West Texas A&M. Both great resources. They'll help you put these things together. They won't do it for you, but they'll help you with these business plans and so forth. And best of all, they're a free resource.
Yeah, Steve, I think a lot of what we covered in a business plan can be overwhelming to most folks, especially with the lack of experience. So relying on some of those resources prior to even visiting with a banker can provide some really valuable perspective, because not only are they going to help you with their business plan, they've helped with over and over and over folks with different ideas, different industries, different offerings, and so they're going to be able to provide a lot of insight that will help you navigate through what you think you want to do and get to what it is that you can really do and do well.
Yeah, and they're very experienced business consultants too, so it really goes even beyond formulating a business plan and how do I go communicate with the bank. They provide a lot of resources as consultants and just do a lot of ongoing business coaching. So we've seen a lot of very successful businesses that have started in that direction, and a lot of those have started their business with us and have become very good customers of the bank. So great resources we have.
Okay, let's move on to our next question.
Okay. Melissa wants to know, how long does the process take?
The process, that's a little tough to answer, just because every transaction we do is a little bit different. It sometimes depends on the size of the transaction. If you have real estate, for example, so real estate, there's a lot of third-party reports required sometimes in order for a bank to do a real estate loan. For example, an appraisal, title insurance. Sometimes there's environmental reports that have to be done. These things can delay potential closing from an application standpoint to actual closing, maybe to a month. So we have a lot of customers. It really depends on the borrowers and how prepared they are. So sitting down with your banker, they'll be able to give you a good idea of, here is a checklist of items that we need in order to start the process of analyzing the credit or underwriting the credit before we actually go in for approval. And if we have a borrower who is able to complete that checklist with the items we need, oftentimes we can move really quick. We have some transactions we can move in a couple of days and actually close the deal. There are some that are more complex that require a lot of research, not only on the borrower's part but also on the bank's part. So understanding the industry, are there any changes that you could foresee in the industry? Just various things that make it tough to answer that question. But again, it can range sometimes from a couple of days and in some cases, several months.
Yeah, I think with the topic being small business or startup businesses, another resource or a program, I should say, that we utilize a lot is the SBA and small business lending. And that's a program that we really run parallel to what we do at the bank and some of the SBA programs. We're able to offer that, if any of you are familiar with the SBA programs. But that is more in depth. Anytime you're looking at a startup and you've got projections as opposed to real life numbers, if you've got speculative business, there's so many different things that can change what you talked about, Scott, being the normal cycle to get a loan done. If you're going an SBA route, that is something. There will be a little bit more documentation. There will be more things to collect, reports to put together. The bank is more than happy and willing to go through that process with you and help you along with everything that ties into that. But again, doing all those and going through all those steps is going to take the process out from maybe a couple weeks to a day to you get to 3-4 weeks. And it also matters how well detailed and how well prepared you are.
Okay.
Excellent. Now, Jeff asked, is there a minimum that you all look for to consider a small business loan?
We don't really have a minimum per se. We get requests all across the board. Sometimes a business that's been around for a while might want to be expanding, and they might be needing a loan in several hundreds of thousands of dollars. And then sometimes we need a business that's just trying to get a little working capital and might need $25,000. We have some products out there that help smaller businesses sometimes with smaller loans. And like Jeff said, sometimes we need or desire to bring in the SBA, Small Business Administration, to help us make those loans. But we don't really have. We look at it on a case-by-case scenario. Don't really have a minimum dollar amount.
Excellent. Stephen wants to know, what interest rate and repayment term can I expect to receive for a small business loan?
Yeah, I hate to keep deferring on some of these, because they're so challenging. But the short answer to most of these questions really is just that it depends. That's not a lack of an answer. It's just...
It's not like a politician.
Right. Yeah, we're in political season, right? When we're loaning on assets, Scott touched on collateral. The type of need it is, the type of collateral that we're looking to finance. Those are the type of things that will dictate what our terms are going to be, how long we're willing to go. On an operating money, sometimes you're looking at a 12-month cycle. We're constantly looking at what your needs are and what your capabilities of repayment are. Whereas a real estate or an equipment type loan, we're going to be able to finance those on a longer term, maybe 5 to 7 years on some equipment, maybe 10, 15, 20 years, depending on the dollar amount and type of real estate you're looking at. So interest rates can be different depending on what we're financing and how we're financing it, just the same as your terms can change. But all of that stuff can be kind of worked through and understood better once you have your business plan together, once you identify what it is you're looking to do and how you're going to be able to do that. Then we can start sort of zoning in on what your type of loan will be and what our terms that we're going to be able to offer.
Okay. Jennifer wants to know, does the bank require me to put some of my own money down to get a loan? If so, how much and why?
Well, that's another question that you kind of have to answer with it depends. But yes, definitely the bank would expect you as the borrower to put some of your own money into the business because we look at it as we're a partner with you. We're not going to go out and do the business ourselves. We want to help you do the business. So we're partnering with you. And part of that process is for you to have some of your own money into that business as well. It's better for you because that amount of money you're not having to pay interest on, you're not having to borrow, and so it helps, like Scott talked about, capitalizing. It helps capitalize that business, and so it's better for the business. It's makes it stronger overall. As far as how much, again, that's going to depend somewhat. I'd say a good rule of thumb, what we typically look for is about 20%. A lot of times the bank will finance 80%, and we would ask for 20% equity. Again, that's going to vary based on the collateral, based on whether or not we have SBA involved, a number of things, but that's probably a good rule of thumb.
Yeah, Steve, just to tie into that, I think, what you're doing and how you're doing it is going to play a big role in what the overall picture is and what they can expect. But on a mortgage deal or a car deal, you're talking about, maybe not necessarily real estate in all cases, but most collateral is going to lose value over time. As time goes by, the value of those assets that we're financing is going to change, and so we're asking for the customer to partner on that, to put some equity into that, so that you stay ahead of how that asset's depreciating and going down in value. So not only does the bank not want to end up with assets that are undervalued, but we don't want our borrowers, we don't want our customers to come in and 2 or 3 years into something have no equity or negative equity in some cases in the assets that we're financing.
It gives a backup plan.
Sure.
Okay. You've mentioned SBA lending a couple of times. Rachel wants to know if we do SBA lending, so if you could expand on that just a little bit further.
Okay. We take that, Scott?
Yes, we do SBA lending. It is a very important part of our business. In the communities that we're in, we love serving the small business owner. So there's a number of different programs that we can use as part of the Small Business Administration program. We are actively seeking and looking for different ideas or concepts for business, and there's various ways of using SBA lending. The short answer is yes, we see that as a big part of our business, and that's something we want to continue. We've devoted a lot of resources. We've trained a lot of people who get involved with that type of business to really kind of help coordinate a loan transaction that we're doing as an SBA loan.
Now, the bank has actually won an award for several years from SBA as being the top lender in this area, in this region, as far as using and utilizing SBA lending. So we utilize SBA quite a bit.
Okay. Now, Francis says, my small business manufactures gun holsters. We have lots of problems finding insurance, etc., because we are high risk. Here's this question. Are there any restrictions on loaning for a high-risk product?
Well, ideally, when you're looking at a product that we're loaning against, and again, there are multiple assets within a business that can be pledged, but we certainly, if we're extending credit on a certain type of asset, it helps us, it benefits us, it benefits the borrower to have those assets insured. Now, in some cases, maybe they cannot be insured due to different risks involved with that type of asset. So we really try to explore any avenue that we can in order to find a way to help our borrowers. So in some cases, maybe we're not able to get there because asset's not insurable, but there may be a real estate property that individual owns that we may be able to do some sort of substitution of collateral, if you will, so we can help. So again, we're really open to any type of business and any industry. It's just a matter of us getting comfortable with that and getting comfortable with the borrower, knowing their competencies and how they run a business, operate a business. So I would say that the answer is absolutely. We would like the opportunity to visit with anyone in a business. It's just sometimes we have to dig in and understand all the different aspects of that before we can maybe extend credit.
Yeah, Scott, and to speak more to the collateral specifically, I think this is a great example of what we've talked about. We've been wishy-washy in some of our how much do you require in or how much should I put my own money in. This is a great example of maybe a unique product or service, what we would consider to be a specialty, inventory type of deal, where if we're able to do something for you, if we're able to come up with a loan on some sort of specialty asset, maybe it's just that we finance a little bit less of that. Maybe you put a little bit more equity in, and that makes it more of a doable deal for us.
Yeah, there are a lot of different ways we can do that.
Okay. That's actually our final question. So do you have any closing remarks or thoughts?
The bank has built our lending portfolio, our loan portfolio, on small business lending, and that's kind of our bread and butter, is what we refer to it. And so we're certainly always looking for opportunities to make loans to small businesses. That's where most of the jobs come from, certainly in our economy, and we're very bullish on small business in Amarillo.
Okay.